Good afternoon. This chapter is on Appendix E, which is our investments in marketable securities. This is taking the place of class on April 16th. It is a very short appendix in your Connect book, and I would like you to read that section. I'll talk about that after I go through these slides. This is just to give you an overview of what you will be seeing and what you'll be reading. So Appendix E, what is it? It is investments in securities. A company may use some of its extra cash to invest in the debt or equity securities of another company. These types of investments must be classified as one of three types. There's securities that are held to maturity, trading securities, and securities available for sale. Looking at securities held to maturity, they are normally debt securities. And the example that I would give most often is when investors or companies invest in bonds. They can be the bonds of the federal government, bonds of a municipality or a state. Those are the most common. Debt securities are usually low risk, and you invest a principal amount and just receive a fixed interest rate attached to it. So that's a type of debt security. And they're called held to maturity because our intent and our ability is to hold it until it matures. So for instance, you might buy a $100,000 state bond that the state uses this money to fix roads and infrastructure and schooling and things. You buy this and get a fixed interest rate of, say, 5% for the life of that bond, which could be 10 years, it could be 20 years. And at the maturity date, you get that principal back. So in essence, you're really investing to earn a higher interest rate than you otherwise would in a savings account, and it's pretty fixed and low risk. The other intent, and the big word here for this chapter is intent. So for the held to maturity, your intent is to hold it to maturity. It is not going to be sold in response to changes in interest rates or funding sources. And it's measured at cost at the balance sheet. So we'd say historical cost. So whatever you pay for this bond or this debt, it's on the books for that amount and it stays on the books for that amount. So the held to maturity follows our historical cost principle. Now we get into the other two options of investments that aren't going to be measured at cost on our balance sheet. Trading securities is the first one. These can be debt and equity securities. They have readily determinable fair values because they're most likely sold on the the New York Stock Exchange or NASDAQ. So anyone looking at those markets at any given point in time will see the same value. So we can put an actual value. It is not subjective. It is what the market is holding. They're bought and held in the near term. So in the 90s, there were these people called day traders. There are still people who do that. But this was typically when the companies were going, lots of companies were going through this there was like this IPO boom, initial public offering, where companies went public. And a lot of individuals would invest for just a day or even half a day or an hour after the security was originally sold, and then they would buy those securities and then resell them at a marked up price, otherwise known as day traders. Very risky. They are actively and frequently traded for profit. That's the key. Trading securities are traded, could be daily. Your motive is to make profit. You need money, you need profit. These are usually high risk. If this is the case, they need to be measured at fair market values and as a current asset because you're buying and selling in the near term, less than a year. So they are measured at fair market value. And again, for our purposes, that'll be looking at the New York Stock Exchange at any given point in time and seeing what that price is. You will also have this new idea, and I'm not going to make you actually prepare financial statements, but you have to know that if it's a trading security, there will be an unrealized gain or loss that will be included on the income statement. Securities available for sale. So whereas trading securities are very high risk, securities available for sale are usually you're just investing in mutual funds, stock markets. There's, low, medium risk, usually not high risk. They, again, can be debt and equity securities. Usually you're buying the stock of another company, investing in it. You have, it could be short-term or long-term. Again, these are traded on the stock exchange for the purposes of this class, so we can determine what their fair values are. They will not be classified as securities held to maturity or trading, because the intent is that we're not necessarily looking to sell them in the short term. We're looking to actually hold them as an investment. They are measured at fair value on the balance sheet. Again, similar to the trading securities, they will be measured at fair value. The difference between a trading and a security available for sale is where that unrealized gain or loss might be. And normally that's going to be buried within owner's equity and in a completely separate section from retained earnings or common stock called other comprehensive income, which we're not going to get into. So really what I'm asking you to know is that the holding gains or losses, which are really unrealized, when we say holding gains or losses, I'm saying unrealized. So because you have to fair market value these securities, you bought them for $100,000, now you look at the fair value at the end of the year, it's $110,000. You need to increase that asset. You need to debit it by $10,000. Therefore, you also need a credit. Where's that credit going to go? For the case of an available for sale, it's going to be buried within retained earnings or other comprehensive income. Just to recap, investment securities, we have held to maturity, no intent to earn a profit in the short term. How do you report it? It's on the books at cost. That's it. There is no fair market value for held to maturity. Trading securities, there is an intent to make a profit in the short term. Therefore, it's measured at fair market value. Either you're debiting the account to increase it to fair market value, or you're crediting your asset account to decrease it to fair market value. And the gain or loss is actually considered an unrealized gain or loss on the income statement. So you place that similar to where you would place gains on sale of property, plant, or equipment. Available for sale, there's no clear intent to sell in the short term, but you may, depending on market conditions, completely depends. They are classified as fair market value on the balance sheet, and any of those unrealized gains or losses are posted as a separate part of stockholders' equity. So for our purposes, we're just going to include them as part of another component of retained earnings, since you will cover other comprehensive income when you get into 321, if you're an accounting major. What does your financial statements look like? Your financial statements will look like, so when you compare what the financial statement would look like for a held to maturity, trading, or an available for sale security, first looking at the balance sheet. Held to maturity, it goes on the books for what it cost us, and we leave it at what it cost us. So you see investment securities at cost, and it does tell us the market value is $7,700, but we can see that we did not increase it at all. So when we look at the income statement, we have investment revenue, a realized gain, net income. There is no unrealized gain or loss with a trading security, with a held to maturity. Also, when you're looking at the statement of cash flows, if you are, you will not see any investment or operating activity related to it because we're not realizing any cash. The cash would have been realized when we actually initially purchased that, that stock or debt. Next, looking at trading security, we can see that in investment securities at market, the cost is $7,000, but the trading security is $7,700. So originally we had a debit in the T account of $7,000, but because the market value at the balance sheet date was $7,700, we increased that by $700. If it's a trading security, you're going to see that $700 on the actual income statement as an unrealized gain. So that's where that amount is flowing. When you look at your retained earnings section, you have, in this situation, $2,200 was just retained earnings. Now you'll notice for the trading security, you also have an additional 700. So instead of just the 2200, you have 2900. If you're doing available for sale, again, you're looking at the balance sheet. It is an investment security at market. So again, the balance sheet needs to be increased for that asset by $700. Notice you will not see any unrealized gains or losses on the income statement because the intent is not to sell it in the short term for a profit. And this is all to make sure that investors can understand what the business is doing. So if you are an investor and see unrealized gains, you know you have trading securities, and that's risky. If you see unrealized gains, the other place you'd see unrealized gains is when you look down at your retained earnings section. So again, looking at the retained earnings for held to maturity, there is no unrealized gains. The retained earnings is what our net income is, so we can assume this is the first year of business. Also, looking at trading, we included the 700 from the unrealized gain in the actual income, so it just flows directly to retained earnings. But for an available for sale, since their intent is we just want to earn, maximize our shareholders' wealth, our net income stays at the 2200 under retained earnings, and we have a separate component, unrealized gain on investment securities. This could have also been a loss, which would have decreased it. So you can see the difference within the balance sheet for these three different types, and that's what I really care most about, that you understand held to maturity is at cost, trading is at fair market value with unrealized gains or losses on the income statement, and available for sale, again, marked to the market value, and unrealized gains or losses are a separate component of your owner's equity. I'd now like to just open up the appendix to the chapter that we're going to be working on. And, oh, sorry about that. This is your Appendix E. You'll notice it's not very long, but it basically goes through what I've just talked about. It gives you information that we were just talking about as well. One thing that this does that I wanted to point out, and we get down here a little further, sorry about that. When we're looking at the cash flow section, just want to make sure that we understand what we're looking at here. We have, in this situation, a held to maturity. We have for cash flow, when we're looking at this, in this situation, this is event one, skipping back there, we paid $9,000 cash to purchase marketable securities. So when you purchase the security, if it's held to maturity, it's an investment, so you see it listed as investment activity. A trading security is operating activity because that's going to be included on the income statement. So it's not an investment because we actually are holding it in the short term. Available for sale would be an investing activity when we purchase that. So just be aware that held to maturity and available are investing activities based on our intent to hold them to recognize gains over the long term, and a trading is short term, so therefore it's included on the operating section of your cash flow. And then similar if you go down to event 3 where they sold securities. I'm not going to get into buying and selling them. I just want you to know the original amounts, but it will tell you if you buy them, you sell them. Again, they will hold the same characteristics. So if you have an inflow of cash from selling a held to maturity, that's an investing activity. Trading is operating, and available for sale is an investing activity. So this is a very good example of what you'll be doing, especially when you're looking at your homework, the 3 homework problems that you have to do, which are your E1, 2, and 5. I'm going to look at those. You also see you have from the slide that I showed you the same exact table here, or exhibit. And then it gives you a little chart here. One thing I wanted to point out for held to maturity, debt, types of revenue, there's interest. When this says reported on the balance sheet, it says amortized cost. You can just ignore the word amortized. It just is at cost. And then it talks about the recognition of unrealized gains or losses. So this is a nice little chart, exhibit E-2. The other thing I want to show you is just the homework quickly. You have your exercises you're going to be looking at. This one is just indicating for each one of these whether you value it at fair market value, pretty much you guys know that its fair market value is only going to be the things we just talked about. Lower of cost or market is actually, we didn't really talk about it too much, but that's your inventory. And then historical cost would be the rest of the remaining assets that we have. Cash would be held historical cost as well. Well, it's fair market value and historical cost, but you can pick historical cost. You can pick historical cost, but if I'm not sure if Connect says historical cost or fair market value, either one. Exercise E2, which you'll be looking at, you are just going through and indicating that you have an event. You purchased marketable securities on March 1st. So when you purchase them for $36,000, we know cash is going to go down, and we have an investment going up. Nothing else is happening here, but then you also have to tell me what cash flow section it is. And again, you can go right back to the ebook and see that tells you. Then it gives you some other information and asks you to look at and figure out on the income statement, what would you see? So again, go back up to that income statement that we showed and you'll go through it. It does give you that they earned revenue during the year of $10,000. There were expenses during the year of $2,000, and then it gives you what the their value at the end of the year was. They purchased them for $36,000. The value went down to $27,000. I would also use T accounts for this. This does set it up this way in Connect, but use your T account so that you can put down a debit of $36,000, and then the ending balance in that marketable security would be $27,000. So how did you go from $36,000 to $27,000? You obviously have a $9,000 loss on that. And how do you show that on your under your equation, if you will? Any questions on this, definitely post them to the Moodle folder, and we'll be monitoring that, and we'll get back to you. Thanks, everybody. Get your Connect homeworks done, and the assignments for lab as well. You have to do E7 for lab. That's due.